So, this is our fourth discussion of mock papers in our webinar series. Hopefully, this will be the last. And in our previous discussions, we have tried as much as we could to pay our attention to almost all the possible areas. And the last discussion will be the discussion of the pilot paper. It will be done by someone, and from the pilot paper you will be able to decide what your final paper will be looking like. But not that I am saying the questions in the pilot paper will be there in your paper, but the paper structure will be almost similar to the structure in the pilot paper. So, you can just navigate yourself to some extent as to what your the exam paper will be looking like by just looking at the pilot paper. Now, we are starting the discussions today. Also, we have a paper. The first question carries 10 MCQs, and we will get on with the first question. Which of the following is a change of accounting policy under LKS 8 accounting policies, changes in accounting estimates and errors? Classifying commission earned as revenue in the statement of profit or loss, having previously classified it as other operating income. Switching to purchasing plant using leases from a previous policy of purchasing plant for cash. Revising the remaining useful life of a depreciable asset. Changing the value of a subsidiary's inventory in line with the group policy for inventory valuation when preparing the consolidated financial statements. And let me start from D. SLFRS 10 says, if, now just to explain with a simple example, if the parent company applies the cost model for property, plant and equipment, and if the subsidiary company has used the revaluation model for their property, plant and equipment, and if you go on consolidating them on line by line basis, within the group, the property, plant and equipment of either companies are considered to be the property, plant and equipment of a single entity. These two entities are considered to be a single entity within the group. And if you do the consolidation as it is without changing to the assets of the subsidiary company, if you do the consolidation, it is going to be a complete breach of LK 16 property, plant and equipment. Why? LK 16 requires the revaluation model to apply to all the assets within a class. Now, if it is say buildings, some of the buildings of the group are at cost model and some of the buildings in the group are at revaluation model. So, then it is like you doing the selective revaluation without doing it collective, and that is going to be a complete breach of LK 16. Then the requirement of all the assets being revalued together when you apply revaluation model has been re-emphasized by SLFRS 10. What does it say? If you consolidate the accounting policies of the parent company, should be the accounting policies to apply for the financial statements of the subsidiary company. And if subsidiary company has applied some different accounting policies which are not consistent to those of the parent company, the financial statements need to be cut and chopped and revised and changed to fall in line with the requirements of the accounting policies of the parent company, and that is just to maintain the consistency and uniformity. And that is what they have done here, changing the value of the subsidiaries inventory in line with the group policy for inventory valuation. So, trust me, hand on my heart, it is not a change in accounting policies, it is not. That is just a memorandum adjustment to the financial statements of the subsidiary companies just to fall in line with the application of to fall in line with the same accounting policies as the parent company. C. Revising the remaining useful life of a depreciable asset. Come on, that is not an accounting policy at all, it is just an accounting estimate change. Even LK 16 requires us to at least annually review the lifetime and the depreciation method useful life. If it is not an SME, you need to review it at least annually. If revisions are required, then and there you need to incorporate the revisions, and that is not an accounting policy change, just an estimate change. Switching to purchasing plant using leases from a previous policy of purchasing plant for cash, and that is not an accounting policy change at all. Why? Whether you buy, if you decide to buy for cash, that is one way of financing. If you decide to purchase property, plant and equipment under a lease contract, that is another way of financing. These are just two financing devices, your own money and lease agreements, two different financing devices, and that is it. And other than that, that does not result in you having a change in your accounting policies. And then a classifying commission earned as revenue in the statement of profit or loss, having previously classified it as other operating income. So, that is a change in how you recognized commission before and how you are going to recognize it now, and that is because of a change in accounting policies, and the answer has to be A. Question number 2, under MCQs, APLC has correctly calculated its basic earnings per share for the current year. Which of the following items need to be additionally considered when calculating APLC's diluted EPS for the year? Now, to calculate the basic EPS, you would have learned it from your normal classes. We take the profit attributable to ordinary shareholders, it is divided by weighted average number of ordinary shares. But for you to calculate the diluted EPS, you not only take the number of shares in issue, also you include potential ordinary shares, possible ordinary shares. What are the examples of possible potential ordinary shares you learnt in your classes normally? There can be quite a lot, but in classes we normally limit that to 4-5 examples, like share option agreements, and there can be share warrants, and there can be convertible instruments like preference shares convertible into ordinary, or there can be debt instruments convertible into ordinary, and there can be contingently issuable ordinary shares. It says first one, 1 for 5 rights of equity shares during the year at 1.2 rupees when the market price of the equity shares was 2 rupees. A right issue is not a potential instrument. It has got nothing to do with the dilution. You include that into the basic EPS calculation. Second, the issue during the year of a convertible loan note. Convertible loan note, you issue a debt instrument now with the option being given to the lenders to get the loan notes converted into ordinary shares. So, at the request of the investors, at the request of the lenders, you should be prepared at any given time to convert these debt instruments into ordinary shares. So, that will result in some ordinary shares being issued in the future. So, that will create some ordinary shares in the future. Potential shares are there. So, second one is a potential instruments, and some more items are given. Third one, the granting during the years of director share options exercisable in 3 years time. Even a share option agreement is an example for potential instrument. Fourth, equity shares issued during the year as the purchase consideration for the acquisition of a new subsidiary company. It's not potential. We have already issued shares. That has to be taken into account in doing the basic EPS calculations, not the dilution. So, there are two potential instruments here, the second and the third. Let us see how the answers are set. All four, which is wrong. The correct should be the second and third. I mean, then B says first and the second once again wrong, and C says second and third only. So, that is what has to be the correct one. Question number 2, MCQs, the correct answer should be C. So, we are moving on to question number 3. Here we go. Although most items in financial statements are shown at their historical cost, increasingly the IASB is requiring or allowing current cost to be used in many areas of financial reporting. DPLC acquired an item of plant on 1st October 2012 at cost of 500,000. Cost has been 500,000. Cost is 500,000. It has an expected life of 5 years, lifetime of 5 years. Straight line depreciation and estimated residual value of 10%. Residual value is deducted in calculating annual depreciation. 50 was deducted. As at 30th September 2014, that is in 2 years time, the manufacturer of the plant still makes the same item of plant and its current price is 600,000. Current price is 600,000. Fine. What is the correct carrying amount to be shown in the statement of financial position of DPLC as at 30th September 14 under historical cost and current cost? Right. The historical part is very simple. 500 minus 50, that is 450 divided by 5, and that will be just 90,000 depreciation for a year. We will check it. 500,000 minus 50,000 divided by 5 into 2 years gone, 180,000. Under historical cost concept, if the asset is recognized in the statement of financial position, the value has to be cost minus cumulative depreciation 180,000. So, it will be 500,000 minus 180 should be 320. Current cost. Now, the manufacturer of the asset keeps manufacturing the same asset, but as he sells the asset, the selling price is no longer at 500, it is at 600,000 rupees. Under current cost method, how much of the asset value to be recognized into the statement of financial position? It's not 600,000 rupees. You need to think reverse. What if you paid 600,000 rupees right at the beginning to buy the asset, and then the cost would have been 600,000, residual value has to be 10% on that, 60,000, divided it by 5 years to calculate annual depreciation, 2 years gone, then 600,000 minus 60,000 divided by 5 into 2, 218,000 would have been cumulative depreciation, cost is 600,000, and if you apply the current cost method, the value of the asset to be recognized in the statement of financial position should be 384,000, 384 under historical cost 320, current cost 384. So let's see what the correct answer has to be. The answer has to be B, 320 and 384. We'll move on to question number 4. RPLC, a company which sells photocopying equipment, has prepared its draft financial statements for the year ended 30 September 14. It has included the following transactions in revenue as the stated amounts below. Which of these has been correctly included in revenue according to SLFRS 15 revenue? Agency sales of 250,000 on which RPLC is entitled to a commission. RPLC seems to work as the agent of a principal, and SLFRS 15 has given some criteria to evaluate, to identify who we are, whether we are the principal or whether we are the agent. Agency sales of 250 on which RPLC is entitled to a commission. So obviously the amount of revenue which RPLC should recognize is not 250, should be its commission amount, which is not given in the question. So then the amount to be recognized into revenue of RPLC in accordance with SLFRS 15 is not clearly given. So A cannot be the correct answer. Sales proceeds of 20,000 rupees for motor vehicles which were no longer required by RPLC. So normally, you know, SLFRS 15 applies for revenue arising on contracts with the customers. Revenue arising from contracts with the customers. Who is a customer? Customer is a person or a party who buys goods and services from you all, from the business, within the normal business activities. What do you mean by the normal business activities? They are our day-to-day business activities, just in the simplest possible way. But if you put that into a more technical version, that is what the business has been set up for. If you want to see what the normal business activities are, you need to question, what is this business existing for? What is this business existing for? And if the business has been set up for the purpose of selling computers is what this business is existing for. So if the entity sells computers, that becomes their normal business activities. But while selling computers within the normal business activities, if you sell an asset like a vehicle to another party, the party who buys the vehicle from you does not become a customer. He is not a customer. He is a buyer but not a customer. For someone to be a customer of a business, he or she has to buy that within the normal business activity, and that is what which is missing in this answer. The question does not say whether the entity is selling the vehicle within the normal business activities. So without that being made clear, we cannot select even B as the correct answer. C. Sales of 150,000 rupees on 30th September 14, the amount invoiced to and received from the customer was 180, which includes 30,000 rupees for ongoing services work to be done by RPLC over the next 2 years. Also, let me go through D. Sales of rupees 200,000 on 1st October 13 to an established customer which will be paid in full on 30th September 15, RPLs has a cost of capital of 10%. Sales of 200,000 on 1st October 13 to an established customer which will be paid in full on 30th September 15, RPLs has a cost of capital is 10%. Now, last month, the revenue figure apparently is 200,000. And are we receiving it right now? No. We will get it in 2 years' time from the date of the invoice. Then the amount of 200,000 is not only including the value and the consideration of the goods and services transferred, also that is including a finance component, significant finance component. Because in this transaction, included in these transactions are two transactions together. What is it? So, that is like you selling the goods right now and collecting money from the customer immediately. Having done that, you have granted, you have lent that money again to the customer as a loan to recover that in 2 years' time. So, then the amount of revenue to be recognized right now is not 200, it has to be the present value, but that is not given in the answer correctly. So, they want us to decide which of these has been correctly included in revenue. 200,000 cannot be the amount to be included in revenue correctly, it has to be the present value, but they haven't given the present value. What they have given us is the amount of 200,000. So, even D has to be wrong, it is not correct. C looks all right because we have received 180,000. Sales of 150,000 on 30th September 14. 150,000, this is the value of the goods and services transferred already, and that is what we have invoiced to the customer. But we have collected 30,000. So, the amount attributable for the goods and services transferred has been recognized into revenue very correctly, and the balance amount of 30 which has already been recognized for the amount of goods and services that are in the process of being rendered has not been recognized into revenue, that would have been recognized into a separate contract liability account. So, the correct way of accounting and correct way of recognizing revenue is in C, not in any of the others. So, the correct answer should be C. Question number 5. TPLC's year end is 30th September 2014 and the following potential liabilities have been identified. The signing of a non-cancellable contract in September 14 to supply goods in the following year on which due to pricing error a loss will be made. And that is a very important matter which you will neglect sometimes even at the exam, but I want you all guys and girls to pay your attention on first item. Now say 1st January 19, you enter into a contract with a customer to supply 1 million worth of goods just in 2-3 weeks time, and this is a non-cancellable contract, irrevocable, just at the consent of one party. Contract cannot be abolished, cannot be cancelled off. And if you want to, you being the seller, if you want to cancel the contract, you can't do it unanimously on your own accord. unless the customer agrees, and so should be the customer, neither can the customer. Then if you promise to deliver 1 million worth of goods and you do not have a present obligation for a liability, why normally for there to be a liability the past obligating event has to occur? This is just a firmly committed transaction. We have a firm commitment to supply goods to the customer and there is no liability as such, and you need not to recognize, you need not to do the accounting for it. But this is something exceptional. Now you promise to sell 1 million worth of goods to the customer, and you need to first purchase the goods from your supplier, say estimated purchase price was 800,000, and you were thinking of making a profit of 200,000 by transferring the goods to your customer. For some other reason, the purchase cost of the goods have risen from 800,000 to 1.2 million rupees, which you can't help about. Now you can't pass on the loss to the customer. It is an irrevocable contract, it is a non-cancelable contract. Whatever you do, however much you try to convince the customer, to make the customer accept, I don't think that will work. So you have no option but to sell the goods to the customer at the same agreed price of 1 million, but you are supposed to pay to your supplier 1.2 million rupees. If you complete these transactions in the future, inevitably there will be a loss of 200,000. Now, if it is non-cancelable, remember, or it can be using another way of expressing by the example, it can be revocable contract. And if that seems to result in you, if that seems to result eventually a loss for you, now and without waiting until the goods are delivered to the customer, you should recognize this 200,000 as a loss. So that is what the first one explains. The signing of a non-cancelable contract in September 14 to supply goods in the following year, on which due to the pricing error a loss will be made, you need to recognize that loss. Now you can't help, you can't, it's irreversible, and first one includes a liability. Remember, you need to get it so clear. Second, the cost of a reorganization which was approved by the board in August 2014 but has not yet been implemented, communicated to interested parties or announced publicly. And if you go through LKS 37, there are a lot of criteria. Basically there are two, but under the first one there are some more. Those criteria need to be satisfied in recognizing a provision for restructuring program. So one requirement is the requirement of the plan being communicated, or the main features of the plan being communicated to the affected parties. Since that part is not completed, the second one does not include the liability. Third one, an amount of deferred tax relating to the gain on the revaluation of a property during the current year. TPL says no intention of selling the property in the foreseeable future. You know, even if the entity does not have an intention of selling the property, if you revalue, you all are supposed to recognize a deferred tax liability under LKS 12. So the third one includes a liability, no argument, you need not to be hesitant. So the third one includes a liability. Fourth, the balance on the warranty provision which relates to products for which there are no outstanding claims and whose warranties had expired by 30th September 14. You had created a provision for warranty sales, but all the warranties given have expired by now, and no longer do we accompany a liability and obligation. So, the fourth one also does not include a liability. So, the first and the third do include liabilities. Let us see the answer. All four wrong. First and second, that is again wrong. First and third, that is what has to be the correct one. So, the answer has to be C, that is question number 5. Correct answer should be C. So, we are moving on to question number 6 now. YPLC entered into a construction contract on 1st January 14, which is expected to last 24 months. The agreed price for the contract was 5 million. Contract price 5 million. At 30th September 14, the cost incurred on the contract was 1.6 million. And the estimated remaining cost to complete is 2.4. Then to calculate the total cost of the contract, you should add them together. To complete the whole contract, the required cost is 4 million. On 20th September 14, YPLC received a payment from the customer of 1.8 million, which was equal to the full amount of the progress billing. What does it say? Total contract price is 5 million. And we have received 1.8 million rupees. The amount you received from the customer is equal to the amount we have billed to the customer. And how can you decide what amount to be billed? That is based on the progress of the construction, progress of the completion. In other words, out of 5 million total contract price, we have completed to an extent like 1.8 million. And with these two figures, we can calculate the percentage of completion. 1.8 divided by 5 million into 100%. So, 36% is complete, 36% is complete. So, what you need to understand is that 1.8 million, the amount received is equal to the amount we have billed, and before you billed, you would have estimated the extent up to which the contract was complete, and the extent up to which the contract is complete is 1.8 million out of 5 million. So, as a percentage, that seems to be what percentage? 36%. Then, we will calculate the total profit. What is the contract price? Contract price is 5 million. What is the total contract cost? Contract cost is 1 million. I made a mistake, contract cost is 4. So, the total contract profit should be 1 million. Contract profit should be 1 million. Then, if the percentage of completion is 36% out of 1 million total profit, the entity can recognize a profit of 360. 360 profit can be recognized. So, what is the question? What do they want us to do? What amount would be reported in YPLC statements of financial position as at 30 September 14 for the amount due from the customer for the above contract? The amount to be recovered from the customer should be the cost incurred. Cost incurred is how much? 1 point. Cost incurred by now is 1.6 million, and the profit figure should be 360. The amount to be received from the customer should be 1960 minus the amount received already 1.8. further amount of 160 is receivable, and that is what you should show in your financial statements, that is the balance sheet. So, the correct answer has to be B. Question number 7. Recognition is the process of including within the financial statements items which meet the definition of an element according to the IASB's conceptual framework for financial reporting. Which of the following items should be recognized as an asset in the statement of financial position of a company? A skilled and efficient workforce which has been very expensive to train. Some of these staff are still in the employment of the company. This is something to be recognized as asset in the balance sheet, to include them in the balance sheet. A skilled and efficient workforce, it is an asset in a normal general understanding, but you need to put it to the definition of assets and the recognition criteria moreover. Among the recognition criteria also, you need to look at the definition of asset. That is one recognition criteria under the latest version of the conceptual framework. For you to recognize an asset, first it has to fulfill the definition of an asset. What is the definition of an asset? It is an economic resource arising as a result of a past event, and the entity should be able to control over it, should be able to have the control over it. Now, for something to be an asset, the entity should be able to control it. The skilled and the efficient workforce, we can control or we cannot control. It is bits of a contentious area. You will think, why can't control our employees? Yes, we can control. If they get late, we can control. If they leave early, we can control. If they are not disciplined enough to concentrate on the work during the office hours, we can control. But that is not what we should look at. And apart from looking at the discipline of the employees, you should be able to control the human being. Human beings are susceptible to the changes of the nature, and you can stop an employee from leaving the company by entering into a contract, by entering into a bond. You can prevent someone from leaving the company in earlier by entering into a bond agreement. But is it possible for us to stop an employee from dying by entering into a bond? Or is it possible for us to stop an employee from becoming mad or insane by entering into a contract? And that is what over which we do not have the control. So, you do not have the control not over the employee, over the mankind, and mankind is an employee, and these two concepts are embedded together, inseparable. So, what is your final conclusion? Employees, talented employees, skilled employees, efficient workforce is not within our control. So, the first one does not include an asset. A highly lucrative contract signed during the year which is due to commence shortly after the year end. Just because you enter into a contract, lucrative, profitable, that is not an asset. A government grant relating to the purchase of an item of plant several years ago which has a remaining life of 4 years. Now, a government grant, that is what the question emphasizes. A government grant is not an asset, rather it becomes a liability. Unless you satisfy the requirements of the government, you are supposed to pay it back. So, more than it being an asset, it becomes a liability. Next one, a receivable from a customer which has been sold to a finance company. The finance company has full recourse to the company for any losses, and that is bit of a tricky one. You should evaluate first before you come to a conclusion. Please don't parachute to a conclusions. Don't hurry. If you hurry, you need to worry sometimes. Customers, debtors, we had 5 million customers, debtors, and we factored. We gave the customers to a factoring company and received money. But see the terms on which we have done it. The finance company has full recourse to the company for any losses. If the factoring company loses out of the collection of the debtors, the factoring company has not agreed to take over the risks of bearing up the loss, and the losses will be transferred back to us. Even though we have sold the assets to another party, it's just that we haven't given the risks and rewards to the buyer. Where you do not transfer risks and rewards to the buyer, it's not an absolute genuine sale transaction. So, the examiner tries to make it look like a sale which is not a genuine, a solid, a true sale transaction. For us, for y'all, for accountants, for that to be a sale transaction, it's not just that we should pass only the legal title, we should pass the risks and rewards, and that is what is lacking here. So, if it is not a transaction of passing risks and rewards to the buyer, it's not a sale, then the selling company, seller should continue to recognize the debtors in the balance sheet, should continue to recognize debtors. So, still the debtors is, despite of the fact that we have factored, should be continued to be recognized as debtors as an asset. So, the answer has to be D. 8.1. On 20th September 14, RPLC's closing inventory was counted and valued at its cost of 1 million. Some items of inventory which had cost 210 had been damaged in a flood and are not expected to achieve their normal selling price, which is calculated to achieve a gross profit margin of 30%. The sale of these goods will be handled by an agent who sells them at 80% of the removal of the normal selling price and charges RPLC a commission of 25%. At what value will the closing inventory of RPLC reported in its statement of financial position as at 30 September 2014. So, the cost is 1 million. Some items of inventory which had cost 210,000 had been damaged and are not expected to achieve their normal selling price, which is calculated to achieve a GP margin of 30%. The sale of these goods will be handled by an agent who sells them at 80% of the normal selling price. Let us take the normal selling price. To calculate the normal selling price, you should take the cost and apply the profit margin. Profit margin, it is a margin, so that is on sales, 30% of sales. So, this is equal to 70 and multiplied by 100, 210,000 divided by 70 into 100, and the selling price would have been 300, normal selling price. Now, the agent buys it at 80% of the normal selling price. 300 into 80% should be 240, and even to to make the sale transaction happen, you need to pay him a commission of 25% and charges RPLC a commission of 25%. So, that has to be again deducted. 240 into 25% is 60, then 240 minus 60 should be 180. Now, the cost is 210 and NRV should be 180. So, you need to write down inventories by 30,000. So, what should be the value? At what value will the closing inventory of RPLC reported? So, the correct answer has to be D, 970,000. 1 million is the cost now. You need to reduce it down by another 30,000. So, the answer has to be 970,000. Ninth one, the following information is available for the property, plant and equipment of F PLC as at 30 September 2014, carrying amount 23,004, 2013 14,400. The following items were recorded during the year ended 30 September 2014. Depreciation charges of 2.5 million. An item of plant with a carrying amount of 3 million was sold for rupees 1.8 million. A property was revalued upward by 2 million rupees. Environmental provisions of 4 million relating to property, plant and equipment were capitalized during the year. The amount would be shown in, what amount would be shown in FPLC statements of cash flows of purchase of plant and equipment for the year ended 30 September 14. So, now let us open up a single T account, and using the T account you can simply find out the amount of cash paid to buy property, plant and equipment for the period. Property, plant and equipment, opening balance 14,004, closing balance 23,400. Then depreciation charge of rupees 2.5, depreciation 2,500. An item of plant with a carrying amount of 3 million was sold for rupees 1.8. So, we will remove the carrying amount, this portion, 3,000. A property was revalued upward by 2 million rupees. Revaluation reserve should be debited to PPE. Environmental provisions of 4 million relating to property, plant and equipment were capitalized during the year. 4 million environmental provision should be debited to property, plant and equipment, and we can close up the account and find it out. 0, 0, this is 9, this is 8, 28,900, 28,009. Let us take the balance in figure 8,500, and this should have been the amount of cash paid to buy assets during the year. So, the answer has to be A, question number 9. Question number 10. On 1st October 2013, BPLC issued 10 million rupees convertible loan notes which carry a nominal interest rate of 5% per annum. The loan notes are redeemable on 30 September 16 at par for cash or can be exchanged for equity shares. A similar loan note without the conversion option would have been required BPLC to pay an interest rate of 8%. How would the convertible loan appear in BPLC statements of financial positions on initial recognition? Simply, it is a compound instrument If it is a compound instrument, you know what is required there. L case 32 requires split accounting to apply to separate out equity and liability components from each other. And you know how to do it. You need to do a small calculation. Let us take the years, let us take the cash flows, and let us take the present values. Present values. So, the bond face value is 10 million and we have to pay 5% coupon. First year 500,000, second year 500,000, third year you should pay the face value plus the coupon interest 10,500,000. So, these are discounted by the market interest rate to calculate the fair value of the liability. 1.08, 1.08 to the power 2, 1.08 to the power 3. And then you can take, this is 465,000 and this is 430,000. You can work it out and find out the answers, calculations. And this is 8,295,000, 8,295,000 fair value of the liability. Fair value of the liability is 9,190. 9,190,000. Then the proceeds from the bond 10 million. Then the equity component 0, this is 1, 810,000. So, the liability component is 9,190, equity component should be 810. So, the answer has to be part A. So, that is the end of the first question MCQs, and we can move on to the question number 2, section 2. Section B, question number 2. HPLC owns a chain of health clubs and has entered into binding contracts with sports organizations which earn income over given periods. The services rendered in return for such income include access to HPLC's database of members and admissions to health clubs, including the provisions of coaching and other benefits. These contracts are for the periods of between 9 and 18 months. HPLC feels that because it only assumes limited obligations under the contract, mainly relating to the provisions of coaching, this could not be seen as the rendering of services for accounting purposes. As a result, HPLC's accounting policy for revenue recognition is to recognize the contract income in full at the date when the contract was signed. Now, if the nature of the business is little awkward and peculiar, something which is not heard before, you need to go through the question again. And obviously, the question has been given from SLFRS 15, revenue from contracts with customers. Then it says HPLC owns a chain of health clubs and has entered into binding contracts with sports organizations which earn income over given periods. The services rendered in return for such income include access to HPLC's database of members and admission to health clubs, including the access to database and admission to health clubs that is given to with and there are members in the sports organizations and HPLC runs health clubs. So, the members in this sports organization can have the access to the health clubs of HPLC. Also, the sports organizations can access to the database of HPLC. Then including the provision of coaching and other benefits. So HPLC will provide services like coaching. You know what coaching means. These contracts are for the periods of between 9 and 18 months. HPLC feels that because it only assumes limited obligations, obligations means performance obligations here under the contract mainly relating to the provision of coaching. This could not be seen as the rendering of services for accounting purposes. As a result, HPLC's accounting policy for revenue recognition is to recognize the contract income in full at the date when the contract was signed. Now HPLC, they have a chain of health clubs and sports organization now can have access to the database of HPLC, and moreover HPLC will be providing services like coaching, and that is the most important part, coaching. And these services will be extended for periods such as 9 and 18 months. So you should apply SLFRS 15. More importantly, you should apply 5-step model in SLFRS 15. And you would have watched our webinar series of SLFRS 15, webinars for SLFRS 15. You need to understand, you need to identify the contract, you need to identify the performance obligations, you need to determine the contract price, and then the contract price is allocated over the performance obligations, and then you recognize revenue when the performance obligations are satisfied. So that is the process. Here the contract, you know what the contract is for, to give the access to the database and to get the coaching and so on and so forth. That is what the contract has been for. And the performance obligations are basically for providing coaching, and contract price, the price is not given, but you know you can determine the contract price, whatever the price that has to be for the coaching. And more importantly here, the most important part here, how the revenue should be recognized by HPLC. HPLC cannot have a practice of recognizing revenue at the time of entering into the contract. And why? Because you need to know, you should realize the fact that the consideration that HPLC collects from sport organizations are to provide services like coaching. That is the performance obligations. So to understand the performance obligation, you need to question yourself as to what is the consideration received for, So as a result, the performance obligation is providing services like coaching. It is over either 9 months or over 18 months. Then these performance obligations are satisfied at one particular point in time or over the period. Here the performance obligations are satisfied over the period. How do we know? You provide the coaching services, at the same time the customer consumes. If the customer consumes the service right at the time of providing the service, and if the customer receives and consumes the service as the services are provided, the performance obligations are considered to be satisfied over the period. So then the entity HPLC has to stop immediately the practice of recognizing revenue at the time of entering into the contract, and they have to develop the practice of recognizing revenue over the period during which the services are rendered, and that has to be the answer for question number 2, section B. Question number 3. In May 2013, HPLC decided to sell one of its regional business divisions through a mixed asset and share deal. The decisions to sell the division at a price of 40 million rupees was made public in November 13 and gained shareholder approval in December 2013. It was decided that the payment of any agreed sale price could be deferred until 30th November 15. So, the decision to sell was in May 2013. And that was at 40 million rupees, and they have taken the approval from the shareholders in November 2013. November 2013. It was decided that the payment of any agreed sale price could be deferred until 30th November 15. This will be deferred over 2 years' time, November 2015. The business division was presented as a disposal group in the statement of financial position at 30th November 2013. Okay. At the initial classification of the division as held for sale, its net carrying amount was 90 million. Net carrying value. Net carrying value was 90 million. In writing down the disposal group's carrying amount, HPLC accounted for an impairment loss of 30 million rupees. Impairment loss 30 million, which represented the difference between the carrying amount and the value of the assets measured in accordance with applicable international financial reporting standards. In the financial statements at 30th November 13, HPLC showed the following costs as provisions relating to the continuing operations. These costs were related to the business divisions being sold and were as follows: a loss relating to potential write-off of a trade receivables owed by CPLC which had gone into liquidation. CPLC had sold these goods to a third party and the division had guaranteed the receipt of the sales proceeds to the head office HPLC. An expense relating to the discounting of the long-term receivable on the fixed amount of the sale price of the disposal group. Third, a provision was charged which related to the expected transaction cost of the sale, including legal advice and lawyer fees. The directors wish to know how to treat the above transaction. So, rather than giving the calculations, of course some of the calculations cannot be given straight, you need to give the proper accounting treatment. Now, the way the question has been treated, that becomes a disposal group under SLFRS 5, non-current assets held for sale and discontinued operations, no issue. And you know, in a disposal group, there are many assets included together. There can be property, plant and equipment, and there can be investment properties, sometimes there can be intangible assets, and there can be inventories, and there can be financial assets, and so on and so forth. Now, if you recognize this as a disposal group under SLFRS 5, it has to be measured at the lower of carrying value and fair value less cost to sell. So, at the time of you transferring that to SLFRS 5, you may recognize an impairment loss. But here, what do you mean by the carrying value? And that is the most important element to be understood. Carrying value is compared with fair value less cost to sell to identify any amount of impairment losses. What is here meant by the carrying value? On the date of the recognition of the disposal group, say we had 600,000 worth of a carrying value of the disposal group where property, plant and equipment were recognized at 100,000 rupees. And this is very important. Before you apply SLFRS 5 and before you recognize any impairment at the time of the disposal group being transferred to SLFRS 5, you need to first and foremost decide the carrying values of each and every single items of assets in the disposal group relating to the relevant SLFRS. Property, plant and equipment. If they have used revaluation model and if the carrying value now is 100,000 and if the fair value is 120,000, the disposal group's carrying value cannot be taken as 600,000 where 100,000 property, plant and equipment is included. Before you apply SLFRS 5, you need to first apply LK 16 revaluation model. You have to do it only if they have used revaluation model, and you need to first revalue the property, plant and equipment and make it 120,000. That is what is accepted to be the accurate carrying value of the asset immediately before it being transferred to SLFRS 5. Investment properties, if the carrying value is 60,000 and if they have adopted fair value model, if the fair value is 75,000, the carrying value of the disposal group cannot be considered to be 600,000 where investment properties are recognized at 60,000. Immediately before you apply SLFRS 5, you need to apply investment property LKS 40 and make it 75 and then change the carrying value of the disposal group. Intangible assets, once again the cost model and the revaluation model. Inventories, if the cost is 120,000, if NRV is 100,000, this cannot be the carrying value where inventories are recognized at 120,000. Write off inventories from cost to NRV if NRV is lower and bring inventories to 100,000, and then you need to recalculate the carrying value of the disposal group with correct carrying value of inventories in accordance with LKS 2. Financial assets. Financial assets can be either fair value through profit and loss or fair value through OCI amortized cost. If the financial assets are not recorded at the required and the correct amounts of fair values or amortized cost, you need to calculate the correct carrying values based on SLFRS 9 and then you need to recalculate the correct amount of carrying value here. And that part has not been done in this question. That part has not been done in this question. And also in calculating the fair value less cost to sell, you are deferring the receipt of the fair value over 2 years time. 40 million should be discounted here to calculate the present value of the fair value. Even the cost of disposal to be incurred in 2 years time should be taken after being discounted at the discount rate given. and then only you calculate the correct amount of impairment losses. So that's what these three items say. A loss relating to a potential write-off of trade receivables owed by CPLC which had gone into liquidation. CPLC had sold the goods to third party and the division had guaranteed the receipt of the sales proceeds to the head office of HPLC. Now if you write off some receivables as bad debts or recognize an impairment, but if someone else has guaranteed to reimburse you, even those reimbursements need to be taken into account in calculating the impairment loss. Expenses relating to the discounting of the long-term receivables on the fixed amount of the sale price of the disposal group, that is what I said, you need to discount the fair value while you will receive the selling price in 2 years time, take it after being discounted, and that is what you need to write in the answer. The content should be what I just explained, and then only you should recognize the impairment loss. Impairment loss has to be determined with the present value of the selling price, after determining the carrying value, after revising the carrying values of each and every single items of assets based on the correct SLFRS. And if you recognize an impairment loss here, that impairment loss is normally recognized to profit and loss, but if there is an impairment loss attributable to property, plant and equipment, and if it had been revalued before, the impairment loss attributable to property, plant and equipment is not debited to profit and loss, that should be recognized as a reversal of the revaluation gain. So that is how you need to explain, and that should be the answer for question number 3. We will go to question number 4 quickly. KPLC is a public listed manufacturing company. Its draft summarized financial statements for the year ended 30 September 13 and 12 comparatives are statements of profit or loss and other comprehensive income for the year ended 30 September 13 and 12. Revenue given 44,009, 44,000. Cost of sales 31,003, 29,000. Gross profit 13,600, 15,000. And the distribution cost 2,400, 2,100. Administrative expenses 7,850 and 5,900. Then investment properties rentals received 350 and 500. Fair value changes 700 and 500. And finance cost 600 and 600. Profit before tax 2,400, 7,003. Income tax 600 and 1,700. Other comprehensive income 1,300, loss last time 1,000, and total comprehensive income 500 and 6,600. Statements of financial position: property, plant and equipment 26,007, 25,002, investment properties 4,001, 5,000, inventory 2,300, 3,001, trade receivables 3,000 and 3,004, bank nil and 300. Equity shares 17,002 and 15,000, 1,200, 2,005, 7,007, 8,700 retained earnings, 12% loan notes 5,000 and 5,000, trade payables 4,200, 3,009, accrued finance cost 150, current tax payable 500 and 1,850, bank balance is 200 and nil. The following information is given. On 1st July 2013, KPLC acquired new investment property at a cost of 1.4 million. On this date, it also transferred one of its other investment properties, plant and equipment at its fair value of 1.6 million as it became owner occupied on that date. KPLC adopts the fair value model for investment properties. KPLC also has a policy of revaluing other properties included as property, plant and equipment to market value at the end of each year. Other comprehensive income and the revaluation reserve both relate to these properties. Depreciation of property, plant and equipment during the year was 1.5 million rupees. An item of plant with a carrying amount of 2.3 million was sold for 1.8 million during September 13. Required prepare the statement of cash flows for KPLC for the year ended 30 September 13 in accordance with LK 7 using indirect method, and this question has been partly from LK 7 cash flow statement, also from the analysis of financial statements analysis, and we will go to the analysis part having completed the cash flow. So, we will quickly prepare the cash flow statements and we will write up the format. Will you? This is using indirect method. Say cash flows from operating activities. Net profit before tax, adjustments for, leave some space for the adjustments and say profit before working capital changes. And then say operating profit. Then say cash flows from investing activities. Then let us take cash flows from financing activities. Cash flows from financing activities. We will start with the adjustments given. On 1st July 2013, KPLC acquired new investment property. We will open up a simple account for investment properties to identify further cash flows, investment properties. Take the opening and closing balances. Investment properties opening balance was 5,000, balance closing balance was 4,100, and during the year we have purchased 1.4 million worth of investment properties for cash, and that has to be taken to cash flow statements and investing activities. Say purchase of investment properties 1,400. On this date, it also transferred one item of its other investment properties to property, plant and equipment at its fair value of 1.6 million. Credit investment properties by 1,006 and debit property, plant and equipment. We will open up another account for property, plant and equipment as well to find out the cash transactions. Let me take opening and closing balances. 25,200 opening balance, and the closing balance of property, plant and equipment should be 26,700. Balance 26,700. And this 1,006 transferred property from investment property should be debited to property, plant and equipment. Investment property is 1,006. K also has a policy of revaluing its other properties included as property, plant and equipment to market values at the end of each year. And if you see other comprehensive income during the current year, there is a loss of 1,300, and that 1,300 loss on revaluation is said to relate to property, plant and equipment OCI, or you debit to revaluation reserve. Other comprehensive income and the revaluation reserve both relate to these properties. Other comprehensive income plus revaluation reserve include the effect of the current year's revaluation loss. Depreciation of property, plant and equipment during the year 1005, and let me credit to property, plant and equipment. You know, here net profit for the period before tax is 2004. This 2004 would have been calculated obviously after deducting depreciation, which is not a cash transaction. To transform this non-cash profit to the cash profit, depreciation figure need to be added back 1005. An item of plant with a carrying amount of 2.3 was sold for 1.8. 2.3 carrying value has been sold off, disposal. We will open up another account for disposal. Disposal, debit 2.3, credit property, plant and equipment, and the selling price has been 1.8. 1.8 rupees cash is debited. You credit to disposal, and that 1.8 should be taken again to cash flow statements under investing activities. Proceeds from the sale of property, plant and equipment. 1,800 is a cash inflow. So that's the adjustments given, and let's take the remaining figures from the profit and loss and the balance sheets given. And let me close up the calculations, and we have taken property, plant and equipment into account and investment properties, and let me quickly take the others. If you take inventories, opening balance is 3001, closing is 2003. There is a drop in inventory by 800. We will put it under working capital changes, 800. Decrease of inventories should be a cash inflow. Decrease in inventory should be a cash inflow. You have sold inventories for cash of 800. That's how you have to argue, but the actual scenarios are different. Reasons why we adjust inventories here, and what happens in nitty-gritty is something else, but we can't explain that right now here. So we'll do the way we used to. Trade receivables, opening balance 3004, closing balance is 3000, and decrease in trade receivables by 400. Decrease in trade receivables by 400 once again should be a cash inflow. Equity share capital has increased by 2200, and we'll put it under financing activities. Proceeds from share issue. Proceeds from share issue should be 2200. 2002. Revaluation reserve was due to the current year revaluation of 1003, and that is why opening reserve figure has become 1002 end of the current year. Retained earnings we have taken. 12% debentures, no change at all. Trade payables, opening balance 3009, closing is 4002, increase by 300. See, increase in trade payables by 300, and that is also like a cash inflow. You stop without paying to creditors, so that's like you generating cash right within. Accrued finance cost, you need to open up a simple account to find out the cash payment, that is the interest charge. Accrued finance cost. What is the opening balance in the credit side? It is 50, and the closing balance has to be 100, and the finance charge during the year is 600, added to profit, say finance charge, and we will credit that to the payable account. 600, close it up, 650, balancing figure should be 550. What is the amount of interest paid in cash during the year, and deduct it from the operating profit. Interest paid should be 550, it is a cash outflow, 550. Then bank, we will take it later. Corporate tax payable, and let's find out the taxes paid in cash during the year. Tax payable, opening balance was how much? Opening balance payable was 1850, closing balance is 500, and how much of taxes have you taken to profit and loss during the year? 600, credit to tax payable 2450, balancing figure 1950. So obviously we have paid 1950 worth of taxes during the year. Taxes paid 1950, right. And we can close up these accounts. Investment property account can be closed up. 0, 0, this is 7, this is 5, 5700, and there were fair value changes during the year. Fair value changes of investment properties during the current year. $700, and it was a loss, rather, it was a loss. Then this account must balance 6400, must balance 00. It is balancing, and this 700 fair value changes have been taken to profit and loss. We know that fair value change of 700 of investment properties are deducted from the current year's profit calculations. In arriving at that 2004, obviously 700 would have got deducted. To transform that non-cash profit to the cash profit, let's add the 700 back. Say fair value changes of investment properties added back. Then property, plant and equipment, close up the account, find out the missing figure. This is 8118. So there is a balance of 5000, and that 5000 is the amount of property, plant and equipment purchased during the year. We will bring it to the cash flow statement under investing activities, say purchase of property, plant and equipment, right, cash outflow. Then we will close up disposal account. Value of the property sold is 2003, the sales proceeds were 1008, and there would have been a loss of 500 on disposal that has been recognized to profit and loss. Even that 500 is not a cash transaction. That loss on sale of asset should be added back to the profit to convert it from non-cash version to cash version. Say disposal on property, plant and equipment. and you need to find out whether there were some dividend payments during the year. How do we check it out? A simple exercise to be carried out. Take the retained earnings at the beginning 8,700 and take the current year profit after tax, profit for the year 1,800 and take the total 0. So, this is 10,005 should be the closing balance of profit. What is the closing profit figure? 7,700, meaning something is missing. What is it? 1,800 worth of dividends have been paid during the current year. Let me put it under financing activity, dividends paid, 1,800 dividends paid. And we have taken almost everything, but let me just quickly run through the profit and loss to see what else has been missed out there. Tax figure was taken, finance cost was taken, rental received, fine, fair value changes taken. So, everything has been taken. Let us work out the final figures. Profit before working capital changes 5,007, operating profit is 7,002. Net cash generated from operating activities 4,700. Net cash used in investing activities 4,006. Net cash used in financing activities 600. Net decrease in cash and cash equivalent during the year 500. Cash and cash equivalent at the beginning 300. So, the cash and cash equivalent at the end should be 200. You can pick those figures from the balance sheets given. We will quickly look at part B of the questions. At a board meeting to consider the results shown by the draft financial statement, concern was expressed that although there had been a slight increase in revenue during the year, the profit before tax had fallen dramatically. The purchase director commented that he was concerned about the impact of rising prices during the year to 30 September 13. Most of KPLC's manufacturing and operating costs have risen by an estimated 8% per annum. Explain the causes of the fall in KPLC's profit before tax figure. Now, the inflation has been, it says most of KPLC's manufacturing and operating costs have risen by an estimated 8% per annum. There is like an inflation of 8% in the economy in which this business operates. And if you just simply work out the cost of sales increase, 31,300 minus 29,000 divided by 29,000 into 100%, that is almost 8%. Yes, prices have increased by 8%. So, even if the prices have increased by 8%, their profitability has dropped drastically from like 5,600 last year, current year 1,008, and they are concerned why even when the prices keep increasing, their profitabilities have fallen down. So, they want us to find out the reasons. There are obvious reasons why the profitabilities would have come down. Now, if you look at the increase in sales, 44,900 minus 44,000, it is 900 increase divided by 44,000 into 100, that is just 2%. Now, even when everyone experiences an increase of prices, inflation of 8%, and even this company has experienced the same thing, but they have not passed that burden to the customers. They have passed that only by just 8%. Why? Sales have increased by just 2%. So, this company seems to have absorbed the effect of inflation to their business without giving the burden to the customers. The part of it can be passed to the customers. So, as a result, their profitabilities will fall. Why? In the light of increasing prices, they would have increased their selling prices, but they have not. They have increased slightly by 2%, which is not adequate at all. Now, the cost, everything is increasing except for the fact they have not increased the selling prices, and the burden of the inflation is not given to the customers, and they seem to absorb, and that is one reason why the profitability has come down. Another one, you know the investment properties, part of the investment properties 1006 were transferred where? To property, plant and equipment. Now the prices keep increasing. When the price keep increasing, even the fair values of investment properties will definitely increase. If it was under under investment properties, fair value changes would have been taken to profit and loss and the profit would increase. Now since you transfer it to property, plant and equipment, the fair value changes, they apply revaluation model for property, plant and equipment, the fair value changes of property, plant and equipment are recognized to OCI equity, not to profit and loss. That is another reason why the profit comes down. Another one, if unless you transferred investment properties to property, plant and equipment, investment properties would have been under fair value model. Under fair value model you do not depreciate assets. But since you transfer it to property, plant and equipment, under revaluation model you need to depreciate assets. And as you revalue, and if the market prices keep increasing, you revalue, and then the depreciation figure also keeps increasing, and that will further bring down the profit of the company. Then you have sold some of the property, plant and equipment, sold, and reacquired some of the properties. So that is a very stupid decision. When you sell, the selling price will be little lower, but if you buy another asset, it must be at a higher price. Unless you sold the existing asset, your depreciation figure would have been based on historical cost. And if you buy a new asset, once again your depreciations will be based on the revised new cost. So once again the depreciation will increase and your profitabilities will come down. So those are the apparently the reasons that would have caused the profits to come down during the current year, despite of the fact that the prices have increased everywhere. So that should be the answer for part B. And we are moving on to question number, last question now, section C, the console question. The statement of financial position of J company and its investee companies, P company at the J and company, P company and S company as at 31 December 19 are shown below. Balance sheets are given: freehold properties, plant and equipment, investments, inventories, receivables, cash, share capital, retained earnings, 12% debentures, trade payables, bank holding. J company acquires 600,000 ordinary shares in P on 1st January 14 for rupees 1 million when the accumulated retained earnings of P company were 200,000. At the date of acquisition of P company, the fair value of its freehold properties were considered to be 400,000 rupees greater than its value in P company's statements of financial position. P company had acquired the property 10 years earlier and the building element is depreciated on the cost over 50 years. J company acquired 225,000 ordinary shares in S on 1st January 18 for rupees 500,000 when the retained earnings of S company were 150,000. P company manufactures a component used by J company. Only transfers are made by P company at cost plus 25%. J held 100,000 rupees of these components in inventories at 31st December 19. If it is the policy of J company to review goodwill for impairment annually, the goodwill in P company was written off in full some years ago. An impairment test conducted at the year end revealed impairment losses on the investment in S company of rupees 92,000. It is the group policy to value the non-controlling interest at acquisition at fair value. The market price of the shares of the non-controlling shareholders just before the acquisition was 1.65 rupees, required to prepare consolidated statement of financial position. So we will write up the format and then we will start doing the calculations. non-current assets, property, plant and equipment, goodwill, investments in associates, current assets, inventories, trade receivables, cash and bank. Ordinary share capital, consolidated retained earnings, non-controlling interest, non-current liabilities and current liabilities. We will open up the required accounts. Cost of control, non-controlling interest, consolidated retained earnings, subsidiary retained earnings, investments in associates, acquisition date is reporting date 31st December 19, and let us look at the acquisition date. 1st January 14, 600,000 shares. What is the percentage? Percentage seems to be 60%. What is the invested amount in company P? It was 1000. So, let me bring this investment figure of 1000 to cost of control to complete the goodwill. 1000 credit investment and debit cost of control. Acquisition date has been 1st January 14, 5 years before the reporting date. Retained earnings on the acquisition date were 200, and at the date of acquisition of company P, the fair values of its freehold property was considered to be 400 greater than its value in P's statement of financial position. Fair value reserve 400 will recognize and also will add it to property, plant and equipment 400. P had acquired the property 10 years earlier and the building element is depreciated on cost over 50 years. So, then at the time of the business combinations 10 years have gone, original lifetime has been 50, another 40 years are remaining. Then this 400 revalued amount into 50% of the building element, that is 200, should be depreciated over the remaining 40 years into 5 years. Let us calculate the required additional depreciation arising out of the fair value adjustment. 200 divided by 40 into 5 should be 25. We will deduct it from property, plant and equipment and debit to retained earnings of company P. 25 depreciation on fair valuation. Let me bring the profits of companies. Retained earnings, parent company has a profit figure of 1460 and subsidiary company has 885, and we have transferred 200 to cost of control on the acquisition date. Then J company acquired 225,000 ordinary shares in S company on 1st January 18, just 1 year before the reporting date, for 500, and that has to be what percentage? Let us work out the percentage. 225 divided by 750 into 100, 30%, that becomes an associate company. What is the profit of the associate company on the reporting date? 390. And what seems to be the profit on the acquisition date? Let's work it out. The profit has been 150, and the invested figure should be how much? 500. Let me bring that to investments in associates. At the same time, we will recognize subsequent equity changes. 390 minus 150 into 30% should be 72. Debit to investment account, say share of associate profit, and credit to consolidated retained earnings by 72, say share of associate profit, 72. And adjustment number D, company P manufactures a component used by J company only. Transfers are made by P company at cost plus 25. J company held 100,000 rupees of these components in inventories on 31st December 19. Who sells? P company manufactures a component. Transfers are made by company P. Obviously, the selling company seems to be, selling company is the company P subsidiary company, and the remaining inventories are given. Remaining inventories are 100,000. So based on 100,000, let's work out unrealized profit. 100,000 divided by the markup is given. Cost plus 25 is the markup. 125 into 25. Unrealized profit should be 20. We'll debit it to retained earnings of company P, say unrealized profits, and we'll deduct it from the inventories. Inventories are deducted by 20. It is the policy of J company to review goodwill for impairment annually. The goodwill in P was written off in full some years ago, and impairment is conducted at the year end. Revealed impairment losses on the investment in company S492 will recognize associate investment impairment and will debit that to consolidated retained earnings 92. Associate investment impairment 92. The group policies to value non-controlling interest at acquisition at fair value. So the fair value of a share of NCI is given on the acquisition date 1.65. Based on that, let's work out the fair values of NCI. So we acquired, parent company acquired, you must make sure that the share capital of company P is denominated by 1 rupee shares. So then parent company acquires 60% and the balance 40% is held by non-controlling shareholders. Based on that, we can value the fair value of non-controlling shareholders. 400 into 1.65. 1.65 into 400 should be 660. NCI 660, and we'll bring it to NCI. Right. So now we can close up and first complete the goodwill. Will complete the goodwill and bring the share capital. Share capital should be 1000 here. Share capital should be 1000. 1660, 1660, goodwill has been 60, and this goodwill has been impaired in full, and since it is the full goodwill, I will debit the impairment to, I will debit 60 impairment loss to subsidiary companies retained earnings. It has to get divided between parent plus NCI both. Goodwill impairment, right. So we can close up, we'll close up 885, bring it to debit side, take the balancing figure. 885 minus 200 minus 25 minus 20 minus 60, balancing profit figure is 580, and we will divide it between parent plus NCI. 60% should be given to parent company 348, and 40% rather should be given to NCI 232. Credit to consolidated retained earnings by 348, subsidiary company retained earnings and credit to NCI by 232, say subsidiary retained earnings. Close up NCI 892, 892, 892, bring it to the balance sheet 892. Consolidated retained earnings, this is 0. Bring it to debit side, take the balancing figure 1880 minus 92 should be 1788. Consolidated retained earnings 1788. Investments in associate company 572 minus 92 should be 480. Bring it to the balance sheet 480 investments in associates. We will take the remaining figures now. Property, plant and equipments, under that we have to take freehold property, plant and equipment, freehold property 1950 plus 1250. Take the consolidated figure 1950 plus 1250 plus 400 minus 25, 3575. Plant and equipment 795 plus 375, 795 plus 375, 795 plus 375, 1170. Inventories 575 plus 300, 575 plus 300, 575. This has to be not 10, it has to be unrealized profit should be 20, please do the correction. 575 plus 300 minus 20, 855. Trade receivables 330 plus 290, 330 plus 290. Consolidated figure should be 620. Cash and bank 50 plus 120, 50 plus 120, 170. Ordinary share capital 2000. Non-current liabilities 12% debentures, 12% debentures 600. Current liabilities, trade payables, 680 plus 350. Consolidated figure 680 plus 350, 1030. Bank overdraft 560. Total current liabilities 1590. Consolidated freehold property 3575. Consolidated plant and equipment 1170. the goodwill is 0 because it has been fully impaired. Investment in associate 480, inventories 855, trade receivables 620, cash and bank 170, total current assets 1645, ordinary share capital 2000, consolidated retained earnings 1788, non-controlling interest 892, debentures 600, trade payables 1030, bank OD 560, current liabilities total 1590, so the balance sheet total should be 6870, and hopefully we do believe that our webinar series on the revision would have been to some extent at least would have been helpful for you all, and hope for the best and wish you all the very best for the exam, and hopefully we are meeting up again to discuss the pilot paper. Thank you for watching our videos.